Welcome to Easika Academy YouTube channel. In this lecture, I want to examine piecemeal acquisitions or acquisition achieved in stages. If you are coming across my lecture for the first time, please like the video, share it with others, and subscribe so that you don't miss my upcoming videos. Thanks for watching Easika. So, step acquisition or piecemeal acquisition. This occurs when the parent company acquires control over the subsidiary in stages. When the parent company acquires control over the subsidiary in stages. That is where it takes the parent company more than one stage of acquisition to acquire controlling shares in the subsidiary company. So where it takes the parent company more than one stages of acquisition to acquire controlling shares in the subsidiary company. Types of business combination achieved in stages. Types of business combination achieved in stages. Types of business combination achieved in stages. Number one, where simple investment is increased to controlling shares. Where simple investment is increased to controlling shares. For example, where the holding is increased from, say, 15% to 70%, or where holding is increased from 10% to 60%, or where holding is increased from 9% to 51%. That is the first type. Number two, where significant influence is increased to controlling shares. Where significant influence is increased to controlling shares. That is where an associate is increased to controlling shares. Where an associate is increased to subsidiary. Take for instance, if you increase the holding from 20% to 51%, or if you increase the holding from 25% to 60%. So that is the second situation. Number three, where the controlling shares in subsidiary is increased. Number three, where the controlling shares in subsidiary is increased. For example, to increase the shareholding from 51% to 70%, or from 55% to 60%, or from 60% to 90%, etc. So that is the third forms of business combination. So this third part will be examined in my next video. I want you to note that for the business combination achieved in stages, the consolidation starts from the acquisition stage where controlling shares is acquired, or consolidation will start from the acquisition stage where control is achieved. That is, where the shareholding is at least 51%. Consolidation starts. Consolidation starts Note, consolidation starts from this stage where control is achieved. It is the stage where control is achieved that you will start consolidating the group. So that is the stage where you have at least 51% shareholding, where the number of shares acquired is at least 51%. Steps for solving piecemeal acquisition, or steps for solving acquisition achieved in stages. Step number 1, determine the percentage of shares acquired in each stage. Determine the percentage or percentages of shares acquired in each stages. Determine the percentages of shares acquired in each stages. Step 2, determine the cumulative percentages of shares acquired. Determine the cumulative percentages of shares acquired. I want to note that consolidation starts from the stage where cumulative percentage of shares acquired is at least 51%. Note, the consolidation starts from the stage where cumulative percentage of shares acquired is at least 51%. Note, consolidation starts from the stage where the cumulative percentage of shares acquired is at least 51%. Step number 3, draw the group structure. Draw the group structure. That is the step number 3. Step number 4, present the summary of the subsidiary's net assets. Present the summary of the subsidiary net assets. Present the summary of the subsidiary's net assets. Note, pre-acquisition retained earnings is the retained earnings of the subsidiary at the date control is achieved. Pre-acquisition retained earnings is the retained earnings of the subsidiary at the date the cumulative percentage of shares acquired is at least 51%. the stage where cumulative percentage of the shares acquired is at least 51%. Remember, I've told you control is achieved at this stage. So that is where you determine your pre-acquisition retained earnings, and that is the stage where consolidation will start from. Step number 5. Step 5, calculate goodwill on acquisition. Calculate goodwill on acquisition. To calculate goodwill on acquisition of the subsidiary, the purchase consideration will be equal to fair value of previously held investment. Fair value of the previously held investment plus cost of investment that gives control. The sum of these two will give you the purchase consideration. Suppose the first acquisition is 35%, and the later acquisition is also 35%. The fair value of the first 35% will be used here, not the cost of the first 35%. Then plus the cost of additional 35% too, that now give the cumulative shares to be 70%. The sum of the two will be the purchase consideration. Then after purchase consideration, you add the non-controlling interest at acquisition. Non-controlling interest at the date of acquisition, you have this. Then you now less fair value of net assets, less fair value of net assets at the date of acquisition, which you will arrive at from the summary of the subsidiary net asset. Then you arrive at the goodwill. And in case goodwill is impaired, you are going to deduct the impairment loss. So that is how goodwill will be calculated. Please watch my earlier presentation for better understanding. I will explain how to present the summary of subsidiary net assets, how to draw the group structure, calculate the group retained earnings. Calculate the group retained earnings. And this have been explained in my earlier video. So calculate the group retained earnings. I want to believe you can do that perfectly. Now, step number 7, calculate the non-controlling interest. Calculate the non-controlling interest that will appear in the consolidated statement of financial position. The step number 8, prepare the consolidated statement of financial position. These are the steps you need to follow when preparing the consolidated statement of financial position involving steps acquisition or acquisition achieved in stages or piecemeal acquisition. Example 1. Roma plc was incorporated with authorized capital of 50 million of $1 each, consisting of 5 million 10% irredeemable preference shares of $1 each and 10 million ordinary shares. As at 1st of January 2009, Roma plc had issued 70% of its authorized ordinary shares. Brown acquired its shareholdings, acquired its controlling interest in Roma PLC as follows. We have date of acquisition, number of shares acquired, and retained earnings of Roma PLC. 1st of January 2023, 700,000 shares, and retained earnings 600,000. 1st of April 20X4, 350,000 shares, retained earnings of 650,000. 1st of July 20X6, 700,000 shares, retained earnings of 740,000. 25th of January 20X7, 2.1 million shares, retained earnings of 810,000. 1st of January 20X8, 1,050,000 shares, retained earnings of 925,000. Required. Determine the pre-acquisition retained earnings in Roma PLC. Stake in preference shares does not determine the parent and subsidiary relationship. So the preference share will not be considered. So, and 10 million ordinary shares. The number of ordinary shares is what we are going to use to calculate the percentage of acquisition. As at 1st of January 20X9, Roma PLC had used 70% of its authorized ordinary shares. The amount issued is the one we are concerned with. So number of shares issued, number of shares issued is 70% of 10 million ordinary shares. 10 million ordinary shares. That will give us 7 million shares. 7 million shares. So the number of shares in issued is 7 million. As at 1st of January 2023, 700,000 shares were acquired by Brown. So now, January 1st, 20X3, percentage of acquisition. So 700,000 shares were acquired, which is 0.7 million, which is 700,000, over 7 million shares times 100. So the percentage of acquisition is 0.7 divided by 7 times 100. That is 10%. Then, as at 1st of April 20X4, 350,000 shares were acquired. So, April 1st, 20X4, 350,000, which is 0.35 million over 7 million times 100. So, that gives us 5%. Then, as at 1st of July 20X6, 700,000 shares were acquired. So, July 1st, 20X6, 700,000 shares, which is 0.7 million. This is 700,000 over 7 million times 100. That gives us 10%. Back to the question. As at 25th of January 20X7, 2.1 million shares were acquired. January 25th, 20X7. The number of shares acquired is 2.1 million out of 7 million times 100. So 2.1 divided by 7 million times 100, that gives us 30%. Then back to the question. As at 1st of January 20X8, 1,050,000 shares were acquired. January 1st, 20X8, 1.05 million shares out of 7 million shares times 100. Divided by 7 times 100. So we have 15%. So we have date of acquisition. Let's organize them in table like the date of acquisition, percentage of shares acquired. Then we also have cumulative percentage of shares acquired. Then we have retained earnings. Now, the first acquisition is at 1st of January 2023. A percentage acquired is 10%. January 1st, 20x3. 10% was acquired. Cumulative will be 10%. What is the retained earnings? As at 1st of January 20x3. Back to the question. 1st of January 20x3, retained earnings was $600,000. We have $600,000. Then as at April 1st, 20x4, 5% was acquired. April 1st, 20x4, 5% was acquired. Cumulative percentage now will be 10% plus 5, that is 15%. What is the retained earnings as at 1st of April 20x4? Retained earnings, that was $650,000. $650,000. Then the next acquisition is at 1st of July 20x6. 10% was acquired. July 1st, 20x6. 10% was acquired. Cumulative will be 15 plus 10. That is 25%. And what was the retained earnings as at July 1st, 20x6? Back to the question. July 1st, 20x6. Retained earnings was $740,000. $740,000. Then the next acquisition was as at January 25th, 20x7. 30% was acquired. January 25th, 20x7. Percentage of acquisition is 30%. 25 plus 30, that is 55%. What was the retained earnings as at 25th of January 20x7? Back to the question. January 20x7 retained earnings, that is $810,000. $810,000. Then the next acquisition is as at 1st of January 20x8. January 1st, 20x8. And the percentage acquired is 15%. We have 15%. So 55 plus 15, that will be 70%. And what was the retained earning as at January 1st, 20x8? Back to the question. 20x8 retained earning January 1st is $925,000. $925,000. Now, what was the requirement? Required, determine the pre-acquisition retained earnings in Roma PLC. I've told you that pre-acquisition retained earnings is the retained earnings of the subsidiary at the date control is achieved. That is where percentage holding is at least 51%. If you look at this, you have 25%. Here is 10%. This is simple investment. Here we have 15%. It's still simple investment. Here we have 25%. This is a significant influence. Control have not been achieved. That is associate. But here you have 55%. This is more than 50%. At this stage, control is achieved. At the date the control is achieved, you have 810,000. Therefore, pre-acquisition retained earnings amounted to $810,000. This $810,000. These additional shareholdings of 15% will be treated as equity adjustment or transactions between owners. Transaction between owners in their capacity as the owners. So this type of transaction will be considered in my next video. So now this very video will be limited to this one. So we have acquisition retained earnings to be 810,000 naira. That is the solution to example 1. Example 2. Company P bought shares in Company T as follows. We have 1st of January, year 1, 40,000 shares at 180,000 naira. This is the consideration paid for 40,000 shares, and retained earnings as at that date is 500,000. As at 30th of June, year 4, another 120,000 shares were acquired, and it was acquired for 70,000 when the retained earnings amounted to 800,000. No fair value adjustment arose on the acquisition. Company T had issued share capital of 200,000 ordinary shares, and retained profits at 31st December year 4 were 900,000. The fair value of its initial investment in 40,000 shares of T was 250,000 at 30th of June year 4. What is the value of goodwill on acquisition? Now, this is the question. Now, let's have solution to example 2. Solution. I've told you the first thing is to determine the percentage of shares acquired in each stage or stages of acquisition. As at 1st of January year 1, 40,000 were acquired, and the total number of shares in issued is 200,000. So now we have 40,000 out of 200,000. Percentage of acquisition January 1, year 1, 40,000 shares were acquired out of 200,000 times 100. Decay there means 1,000. 40,000, 40 divided by 200. So we have 20% times 100. That is 20%. Then another acquisition as at June 30 year 4. June 30 year 4, we have 120,000 shares were acquired. So June 30 year 4, 120,000 shares, 120,000 from 200,000 shares times 100. So 120 divided by 200 times 100, that is 60%. So now, if you have date of acquisition, percentage acquired, cumulative percentage of shares acquired, then retained earnings. The first acquisition was in January 1st, year 1. Percentage acquired was 20%. 20% is just a significant influence. Cumulative percentage is 20%. And how much is the retained earnings? As at January 1, year 1, retained earnings was 500,000. 500,000 naira. At this stage, control have not been achieved. 20% is just a significant influence. So we have June 30 year 4. June 30 year 4. Another 60% were acquired. Cumulative shareholdings will now be 20 plus 60, that is 80%. And what is the retained earnings as at 30th of June year 4? We have retained earnings of 800,000. 800,000. At this stage, the shareholding is more than 50%. So that means control is achieved at this stage. So this 800,000 is the pre-acquisition retained earnings. Now, if you were told, ordinary shares, and retained profit at 31st December year 4 were 900,000. The fair value of its initial investment was 40,000. Shares of T was 250,000. At 30th of June year 4, what is the value of goodwill? We said to determine goodwill, calculation of goodwill. To calculate goodwill, we say you are going to start with purchase consideration. We say purchase consideration equal to the fair value of previously held investment. The previously held investment, the first investment was 20%. What is the fair value of this 20% investment? Back to the question. You were told the fair value of its initial investment in 40,000 shares. You know, the first investment was 40,000 shares, and the fair value, you were told the fair value was 250,000. Shares of T was 250,000. This is the fair value of previously held investment. So, if this is the fair value, the cost of the previously held investment is 180,000. So the fair value is 250,000. Fair value of previously held investment, 250,000. Cost, you add cost of additional investment that give control. Cost of additional investment that gives control. So the additional investment is additional 60%. What is the cost of this 60%? Back to the question. The cost of the 60% is 780,000. So you add 780,000. So this is the purchase consideration. 250,000 plus 780,000. That gives us 1,030,000. After this, we add non-controlling interest. Non-controlling interest at acquisition now are not controlling interest. If you go through the question, you are not given non-controlling interest anywhere in the question. So you will need to determine the non-controlling interest. For our purpose, you will need the summary of the subsidiary's net asset. What is the summary of the subsidiary net asset? Summary of subsidiary. Who is the subsidiary? No, P is the parent. P acquire shares in T. Summary of T net asset. So we have post acquisition retained earnings. We have date of acquisition. We have DOC, date of consolidation. So you start with share capital. Share capital. The total share capital of T. Company T had issue share capital of 200,000. The total share capital of T was 200,000. So we have 200,000. The same amount is what you are going to have in DOA. Then, retained profit at 31st December, year 4 were 900,000. So you have retained profit. Retained profit. You have 900,000. You were told retained profit at 31st December, year 4 were 900,000. The fair value of the previously held investment is what you are given. Now, how much is the retained profit at the date of acquisition? So which was our pre-acquisition retained earnings? We have determined that. We've identified that to be 800,000. That is our retained profit at the DOA. So you have 800,000. That means post-acquisition retained profit will be 900,000 minus 800,000, which is 100,000. So if you sum up, this is 1.1 million. This is 1 million. And here we have 100,000. So this is the DOA. Now, the percentage acquired is 80%. That means non-controlling interest will be 20%. So our NCI now will be 20% times net asset at the date of acquisition. We are going to use the proportionate share of net assets since the policy was not stated. Examiner is silent as regards the policy. So we have 1 million shares. So 20% of 1 million, that gives us 200,000. If you add 200,000 to 1,030,000, you have 1,230,000. From this, you now deduct fair value of net assets at the DOA, date of acquisition. The fair value of subsidiary net asset at the date of acquisition amounted to 1 million. So you deduct the 1 million. 1 million. If you subtract 1 million from 1,230,000, so you'll be left with 230,000. That 230,000 is our goodwill. That is goodwill. So it is the goodwill. Before I take the example 3, I want to explain the treatment of the difference between the cost of the previously held investment and the fair value of the previously held investment. You know, you were told the fair value, the cost of this 40,000 shares was 180,000 and its fair value was 250,000. This results in a fair value gain of how much? 250,000 minus 180,000. We have the fair value gain of 70,000. The fair value gain of 70,000 will be adjusted in the retained earnings. The resulting gain on remeasurement. The resulting gain on remeasurement of the previously held equity interest. Remeasurement of the previously held equity interest. Previously held equity interest is recognized. In profit or loss or other comprehensive income, as appropriate in accordance with IFRS 9 financial instruments. IFRS 9 financial instruments. So that is the difference between the cost of the previously held equity interest and the fair value of the previously held equity interest. You are going to recognize it in the profit or loss or other comprehensive income. Where examiner is silent, you know that it will go to profit or loss because the default is the profit or loss. Where it is to be recognized in other comprehensive income, it will be stated in the question. Now let's take example 3.